In Tokyo, a head and shoulders doesn't mean you need a dandruff shampoo. In Mumbai, a double top isn't two horns on a bull. In Frankfurt, a double bottle isn't a plumbing disaster. And in New York, a bearish engulfing isn't a scene from a nature documentary. There's one language that connects every trader on every desk in every time zone. It's the visual language of fear and greed and, oh, I definitely should have a stop loss. It's the sharks. Welcome to Traders of the World, the only show fluent in the native tongue of the market. I'm your host today, Flavio Lemos, and joining me in today to my co-host Marta Matsumura. Marta is a certified financial analyst with over 16 years of experience in commodities and capital markets, focus on data-driven analysis and macroeconomic trends. Welcome, Marta.
It's great to be here, Flavio. Thank you for the invitation.
Okay. Our guest today is a true intellectual powerhouse in the world of finance. She is the vice president of the CMT Association Board of Directors, holds a PhD, and has earned three of the industry's most prestigious designations: CVT, CFA, and CFP. Her groundbreaking research challenges the efficient market hypothesis, using hard data to show where, when, and why technical analysis works. Beyond her academic brilliance, she is a passionate leader and mentor, dedicated to supporting the next generation of talent and promoting women in our industry. Yeah. It is a distinct honor to welcome Dr. Kelly Corbiere to the show. Dr. Kelly, thank you so much for being here.
It's so good to be with you. Thank you for the invitation, Flavio.
So here's the plan. Grab your coffee, make it a double, and focus right after the intro.
You ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
So, ladies first. Marka, please do the honors of the house.
Kelly, looking at your credentials, PhD, CMT, CFA, and CFP is extraordinary. Most professionals focus on just one of these. What drives your passion for learning and mastering these different demanding disciplines in finance?
Martha, thank you. This is such an intellectually stimulating industry, and I think it's impractical to think that once you get out of college, you'll know everything there is to know. There is just so much out there. We have a good crisis every 3 or 4 years, is what I tell people. So there is just so much to learn. And if that's not your mindset, this probably isn't the industry for you. In fact, despite that background, I joke with people that I want to be a chief investment officer when I grow up someday. So my next designation is probably the CBE, or Certified Business Economist kind of designation.
Martha, what are some of the best and worst investment decisions you have made in your career?
That's funny. One of the worst decisions, I think I was just telling a colleague this afternoon that it was probably late 2006, and Apple, which had been on the brink of bankruptcy the year before, was not on the company's approved list. So I talked a client into selling Apple just days before the iPhone was released. And the Apple is now up over 10,000% since then. So that client probably still swears and uses all kinds of profanity when he thinks about me. Uh, the best investment decision, on the other hand, I think is really more about risk management. That happened in 2008. And a client, a very conservative client, held a Chrysler bond that had just 30 days to maturity, but they only had 22 days of liquidity. So I talked him into selling that bond at 93 cents on the dollar, which is obscene just a month before maturity. But he avoided a big loss in that situation. So, I mean, the list goes on and on. I mean, in my own personal retirement account, I saved, so that was a good decision. But the bad decision there was I was a bond girl when I started my career. So I put all of my savings into bonds, which, as we know, are there to protect your money, not to grow your money. So when I divorced, my ex husband thought I had embezzled money from the family accounts because there was so little in that retirement basket.
Your work covers technicals, fundamentals, and behavior. If you had to drop one tool for a year, which one goes and why?
Technicals and behavioral analysis all work together. It's hard to drop any of those. But if you're talking about a 1 year time horizon, it might be the fundamentals. And I know that sounds blasphemous because fundamentals are what matter long term. But short term, the supply and demand of the stock and what the market is thinking about the stock, meaning the market psychology, is often what moves prices on a day-to-day basis. So yeah, I guess fundamentals would have to go temporarily.
Okay. So, Martha, when clients ask for an edge, what do you actually think that means in public markets today? An edge.
Ooh, there's a lot of things that are happening that are atypical. There's economic populism in Washington, D.C. There's the debasement trade and the possibility that the U.S. dollar could lose reserve currency status. We had negative interest rates for a long time. We had negative oil prices, and we have a host of geopolitical and other risks. So the difficult thing is understanding the ramifications of all of this. There is not a textbook in the world that says this is how you should invest with that macro background. So the real edge comes from being able to think critically about how all of these factors work together. And, you know, that comes into play when you think about the fact that we've had a very high return environment over the last several years. Passive investments have worked very well, which is consistent with market efficiency. But if returns are lower, it will be easier for active managers to potentially outperform in the future. So what got you here might not get you there, is what I like to tell people.
Your research takes a direct run at the efficient market hypothesis. What was your point zero? That moment you decided you needed to go rigorously test this long academic held belief. And as a follow-up, which of the Latin America countries you studied turned out to be inefficient?
That's a good question. I think anyone who's taken a finance class knows that in Finance 101, they teach us the efficient market hypothesis and treat it like a religion. So when I got to my PhD program, one of the first pieces of academic research I did was to look at the Pakistani stock market, the KSE 100, to look at whether there were more trends in that market or more strings of positive and negative days than would be the case in a purely by chance, in a random market. And what I found blew my mind because found evidence that that market was not efficient. So when I did my dissertation, I expanded that, looked at 44 different countries, and I did find that EMH, meaning the efficient market hypothesis, is probably wrong. It gives us no information about when in a country's development the market should become efficient. So I guess you're just left to assume that markets are born efficient and they stay that way indefinitely. And the data shows that that's just not the case. Now, to your point, Flavio, where you're talking about Latin America, I looked at 5 Latin American countries: Peru, Argentina, Brazil, Chile, and Colombia. And 4 of those 5 were inefficient over the entire 15-year test period. And that kind of surprised me, especially in the case of Chile, for example. That had the most inefficient years of any of those 5 countries. And my suspicion, although I need to do more academic research on that, is that it's potentially the degree of retail investment in that market that may be pushing prices away from their value. So stay tuned on that one.
Okay, Ali, one more question on this. Uh, for our audience, what is a efficient market?
Oh, good question. I should have explained that. But in an efficient market, all information is priced into stocks. So the implication of that is that prices and value are always the same. There are no mispriced stocks in a market or no mispriced commodities or bonds or anything else if the market is efficient. The only time that prices should move is when new news comes out. And we know that's not the case. We know prices move all day, every day, despite a complete lack of news. Um, but it also means that when markets are efficient, we should simply buy passive investments like exchange traded funds, and no tool, meaning fundamentals, technicals, or anything else, should help us add value or add alpha in a market. And I've always had this dissonance because I wholeheartedly believe markets were efficient. Yet there's this multi-billion-dollar industry that we all work in, picking stocks and investments and allocating assets. And if markets really were efficient, how can you justify the existence of that market? So this data really helped me better understand the value that we add to clients.
So traders don't have a job on on the efficient market.
That's exactly right. I mean, the only thing they're doing is pressing a button and buying passive investments.
You found that market inefficiency peaked in 2008, a year of massive losses, which you argue support behavioral finance theories. Could you talk about that connection? And how do fear and large scale losses break down markets' efficiency?
Because in 2008, of those 44 countries that I examined, I think 43 of them were inefficient that year, especially in the frontier market basket, more so than the emerging market basket. So that made me think maybe something's going on there. And when I tested the data, it did show a statistically significant relationship between returns and inefficiency. And what I mean by that is that when returns are negative, markets have a higher probability or higher odds of being inefficient. And you don't have to think much farther than our own portfolios to know why that works. We do silly things when the market's down. In March of 2009, for instance, the bank that I worked for saw its stock fall 75%. So what I did, instead of buying that stock, was to sell emerging market stocks and to sell a bunch of other stuff in my portfolio when I was a young investment person. So those biases that we have tend to manifest themselves more so when we're fearful.
Kelly, the CMT Association, which I'm the president of Brazil chapter, defines tech analysis as a toolkit to navigate the gap between intrinsic value and market price. Your work finds that in inefficient markets, the price is often wrong, and your research gives traders a practical roadmap for these situations. So you have identified that tech analysis works best in specific conditions, like when returns are negative or during high geopolitical risk. So how can traders use tech analysis to identify and potentially profit from that gap?
Well, fundamentals are a guess. You know, when you put a model together about what earnings will be, there's some really brilliant people out there, but it still involves some guesswork. Price, on the other hand, volume, on the other hand, those are facts. And that's why technical analysis works as well as it does, because we're using the factual piece of the market. Now, I do think using these tools together makes the most sense. But when everything's down, market is crashing, every single stock out there looks like a bargain on a fundamental basis. So valuation alone is not going to help you. On the other hand, if it's 1997, stocks have been going straight up, everything looks expensive and fundamentals aren't going to help you, but the technicals will. So I think there are certain environments or certain regimes that one tool works better than the other, but technical analysis is always a complement that works very well.
And not forgetting the frauds, the balance sheets that were cooked now. Enron, for example. How can a fundamental analyst use fraudulent balance sheets?
Was a fundamental equity analyst for a long time.
Sure, entrepreneur.
I've come to believe that my hands were tied without having the technical expertise at the time. In fact, the person I worked for said 5 times that I should stop talking about this voodoo referred to as technical analysis because it just didn't help. And now in retrospect, I see that you could make any case based on the numbers. You can make a bull case or a bear case. But when you use the preponderance of evidence and use these tools together, that's where you have a really, really powerful investment thesis that makes money. It's not just relying on theory.
Talk about this. What's the behavior pattern that actually helps long-term returns, not just hurts them?
I like that question. I'm going to say loss aversion. And the reason I say that, well, so to back up, loss aversion is an idea that Dan Kahneman and Amos Tversky put forward. They earned a Nobel Prize for it, at least Kahneman did. And it says that when we lose a dollar, that hurts us a lot more emotionally than when we gain a dollar. And we don't like to lock in losses. So when markets are down, if that deters us from selling and it keeps us invested, keeps us in the market, I think loss aversion can be a very good thing. It also might cause us to diversify, to reduce the churn in our portfolio. So there can be some very positive things from that loss aversion. I also think status quo bias can do some similar things in that it causes us to remain invested. Now, of course, if we don't have a solid portfolio, it could be a double-edged sword, but there are some biases that could work to our benefit.
Your work strongly supports the adaptive market hypothesis. As technology, AI, and retail participation changes the landscape, how do you see the practice of technical analysis adapting in the years to come?
Ooh, that's a good question too. I think there's a lot of ways that the discipline can evolve. Right now, we tend to look at a chart and we tend to say it's either bullish or bearish. It's a binary issue. But with more data, more computing power, we might be able to say, hey, with this pattern, this is what we see 58% of the time. And when we see it, it leads to an alpha of, say, 160 basis points. So we can be more precise about what these patterns may or may not do. We can also, and we're already doing this, but we can use some cross asset confirmation. You know, when equities are doing this and the dollar's doing this, this is what we have typically seen. And then finally, I don't know that we're using technicals as much as we could on the wealth management side. So, you know, we're starting to talk about moving into that area, but the more that we can tell that story to individual investors and move from what's typically been more of an institutional tool, I think will be positive and will be practical as we evolve technologically.
You are known for public speaking and teaching. What needed market history for a smart non-financial listener?
So, what I recommend reading for a non-financial listener, there's an economics book called Murder at the Margin by an author called Marshall Jevons. And that's really a pseudonym from the last names of 2 famous economists. And it talks about economics, but in the form of a murder mystery. So that's a really fun read. I was going to say Dan Ariely has a book that's on the older side, but it's called Predictably Irrational, if I'm not mistaken. And he talks a lot about these different biases. You know, he gave students a ticket in a lottery, and when they were going to sell them, those students that won them thought the tickets to this Duke basketball game were worth $10,000 each, but the students who were charged with buying those thought they were only worth a few $100s each. So that speaks to the endowment bias. And there's a number of other stories and vignettes in that book that really underscore the same things that we're talking about with regard to traders and investors that trip us up. We are just not as rational as the economic models say we are.
So, shifting gears, your posts show you're very passionate about mentoring and supporting women in finance. Why does that matter so much to you? And what's the biggest piece of advice you'd give to young women starting out?
Oh man. Former Secretary of State Madeleine Albright once said very famously that there's a special place in hell for women who don't help other women. There's another quote that I love that says, empowered women empower women. And the fact of the matter is, at least in the United States, if you have an investment advisor, the probability is 80% that he'll be a white male. If you're at a CFA event, CFA Society event, probability is that 70% of the people in that room will be male. In fact, I was at a professional event today, and roughly 1/7 of the people in the room were female. So 4 people out of the whole group. We need more voices in this industry. We need to complement one another and learn from each other. So to your question, Martha, um, um, so my advice would be to get a mentor, to learn everything you can. Look at people who are doing things well in the industry and learn from them. And look at people who are making a complete mess and learn from them. But get as many mentors, as many sponsors as you probably can. Talk to a diverse group of people because there's so much to learn. There's so many different ways to do things in this industry, and you can't do it by yourself.
You recently wrote about the power of executive coaching and self-reflection. In a data-driven field like ours, why is this kind of introspection so crucial for a trader's success?
That probably goes back to a number of things that we've already talked about. If you think you can do this on your own, it's generally hubris. However, on the other hand, if you can be introspective, if you can take constructive feedback, and some of that feedback is going to come directly from the market itself every single day based on your returns, that's the kind of thing that will give you an edge. And that's the kind of thing that will help you add real alpha, real returns, and not just get lucky and make money when the market goes up. Anybody can do that.
Okay. You have urged people to read everything, especially books that challenge and unsettle you. But let's talk about tech analysis. Which tech analysis books do you recommend?
Olá, espero que esteja gostando da entrevista. A Trader Brasil foi eleita por 2 vezes no Rank Awards 2024 e 2025 como a melhor academia de formação de investidores do Brasil. E ela tem um presente para você que está assistindo esse podcast. 10% de desconto, é só usar esse QR Code que está aqui embaixo e a gente te espera lá, ok? Agora não esquece de dar uma moral pro Flávio. Curte, compartilhe esse vídeo e se inscreva no nosso canal, ok? Até a próxima e obrigado pela presença. Valeu!
I just got back from the CMT Summit in Dubai, Flavio, and they recommended a couple of things that I'm reading right now. One is market breadth indicators.
My friend Gavin Morris.
Exactly. A great one. And the other one is Extraordinary Popular Delusions and the Madness of Crowds. And this is interesting because this one was initially published in 1841, if I'm not mistaken. So almost 200 years ago, they were talking about the same biases that we're still talking about as investors.
I am a personal friend of Gavin Morris and his wife, Nancy. At least I know that. Yes. Yeah, they were here in Rio with me and we have a good time together. And I started to build some market breadth indicators on Brazilian market. On my blog, I'm doing Python something because it's tough to get the data to get new lows. For instance, new lows and new highs, you had to calculate. In US, you have everything on your screen, like traders index, new high, new lows. We need to make a code in Python something to do that. But I'm doing that, and fortunately, some software house will hire me, and I can make to everyone.
What emerging frontiers in technical analysis or behavioral finance excite you?
I would say the ability to do more academic research like we did, or like we're starting to do. There are some really, really, really great studies out there, but they're not studies like Fama and French. They're not studies that get cited thousands and thousands of times because we just don't have the computing ability to look at a chart to say, is that a head and shoulders or is that the first couple of waves of an Elliott wave? I mean, it's just not as concrete as the the numbers that you use for some of this fundamental analysis. So as we get the ability to produce some of this knowledge and have that evidence, my sense is that technical analysis will become much more mainstream. A lot of people are using it. They know it works, but they don't necessarily know why it works. And there's also a fear that as more people learn it, the edge may go away. So again, having technicals become sort of pari passu with fundamentals is a huge, huge development in the industry.
What is a widely held belief about markets you think will cringe in 5 years?
Oh, that's an easy one. That is, it's different this time. If I had a dime for every time I heard that and why it's different, but it's not different this time. Long-term valuations do matter. Fundamentals are absolutely a piece of the pie long-term. And you can make money short-term in a lot of different environments, doing a lot of different things, but it is not different this time. The rules of investing are the same as they've been for decades, and bubbles and crashes will continue to occur because we're human and because our emotions get the best of us.
Finally, you have seen methodologies and markets evolve for decades. For the new generation of traders and advisors today, surrounded by social media noise and algorithms, what is the most timeless piece of advice you can offer for building a long and a successful career in financial markets?
I would say know the history. Markets work in cycles. History doesn't repeat, but it rhymes, like people say. So know what happens in different environments. One thing that actually scares me a lot about the new generation, is that none of us have worked in an environment of stagflation. So if for some reason we are going back to a low growth, high inflation environment, and that is possible, especially with the 6% deficits in the US, 120% debt to GDP, and $37 trillion worth of debt that would take 32,000 years to pay back at $1 a second. If that's the case, there are just few of us that live through that environment. So we need to study the textbooks, but we also need to be able to think critically. One of the biggest biases in this industry is that I feel like we're studying each other's homework, meaning if I read only what you produce, Flavio, or what you're saying, Martha, about the equity markets, and it impacts me, I'm not really making a decision independently. So even in theory, the efficient market hypothesis shouldn't work because the errors will no longer average to zero. So no history, no statistics, no finance, no investments, and don't stop learning. And there's some great stuff on TikTok, but professional designations like the CMT, like the CFA, those matter.
I agree with you. I have CFP too, and a lot of letters. Series 7, Series 3, Series 24, Series 3, what? I can't remember now. And CFP too. Dr. Kelly, your insights are a gift to our entire community. Thank you for your immense contribution to the field and for sharing your time with us today. It has been a true privilege. How about our audience could find you on social media, LinkedIn, something like this?
Absolutely. I'm on LinkedIn and I would love the followers. Been a privilege, Flavio. Thank you, Martha.
That's all we had for today on Traders of the World. A huge thank you again, Dr. Kelly, and to my co-host, Martha.
Thank you very much, Flavio, for the invitation. And it was a pleasure to talk to Dr. Kelly. And I want to thank her for sharing her insights with us today.
Thank you very much, Martha. Until next time, trade with discipline, stay patient, and let price be your guide. Take care, folks. Bye.
Feito 20 perguntas, a gente tá
Eu preparei 15 perguntas aqui, ainda teve umas 2 ou 3 de bônus aqui, mas
ela é muito técnica, né? Ela é bem direta, eu gosto disso. Bom, se eu tiver a oportunidade de mandar uma mensaginha para ela, eu mando para ela depois.
mando sim. Se você quiser escrever, eu encaminho aqui.